I'm Chris Frostad, President and CEO of Purepoint Uranium. We are an exploration company operating in northern Saskatchewan, and we are fortunate enough to be partnered with some of the industry's larger players, Cameco, Orano, ISO Energy, Foran Mining, which affords us a number of opportunities, which I think is what we're here to talk about today.
All right. My name is Chad Peters. I'm President and CEO of Ridgeline Minerals. We are a hybrid explorer focused on precious and gold metal exploration in Nevada. We have deals with multiple partners with very active drill programs going on in 2025.
Chris, Chad, thanks for joining us. We are indeed going to talk about business models today, strategies, and those strategies evolve over time. But I particularly liked what you two have done. You kind of set yourselves up for success using someone else's money. What's not like about that? Chris, why don't you kind of run through a bit more detail in terms of what deals that you've got in place, and then maybe Chad, you do the same in a second.
Sure. Well, where we are in Saskatchewan and where the uranium universe is right now is there's a lot of pretty much greenfield exploration going on. There's a lot of discoveries made in that area year after year. So that's really where we've been focused. And so right now we have 10 projects, and 6 of them are under joint venture. We have in each of those cases we own between 21 and 50% of the project. We operate all of those projects, which affords us a management fee. And so the process is fairly, we've gotten into a bit of a role now. So we are able to, on an annual basis, we will provide suggested programs for those projects. Our partners will come to us and we'll discuss budgets and decide how much we want to spend, how much we want to do. And then we will execute those programs through the year, reporting back. And by the end of the year, we're ready to see what we're going to do in the next year. But it gives us a lot of opportunity to really explore properly, because it's very expensive where we are, and it takes a lot of money to do so. And we've been at this for a while, and we've seen a lot of our peers come and go. Because essentially there's so much money you're trying to raise and put in the ground over a long period of time, you eventually dilute yourself and your investors into oblivion. So in this particular model, where we're spending, $5, $10, $15 million a year we could be putting in the ground, the lion's share of that is coming from people with bigger balance sheets than we have. And on top of that, it keeps us busy, and the fees that we charge, the management fees that are part of that, pretty much pay for our overhead. So I think we've kind of turned exploration in northern Saskatchewan into a sustainable business, which is an odd place to be, but I think in this particular market, it's going to work.
Right, and Chad, you've got a similar kind of model going on there. If you're going to quickly scoot through that, but where I would like you to talk to is how you go about selecting the right partner, and then what position are you to actually dictate, negotiate on an equal footing with that partner.
Yeah, and Chris kind of covered. He's sitting there giving his pitch, and I was like, yes, that's exactly. We're the same things. I love it. We're in a very similar position, right? We have 7 projects. 3 of them are in deals with between South 32 and 2 deals with Nevada Gold Mines, and we've structured our deals in a way that. We have fully retained carried interest to commercial production for 20 to 25% of each asset. So the idea being, again, is use other people's money, get that money in the ground fast. We also collect management fees, which is wonderful. We're going to be cash flow positive through the end of the year on our South 32 deal. And the way that we really I don't know about Chris, I'd be interested in hearing this, but if he started the company as a prospect generator / hybrid explorer, or were you going just for going to make your own discoveries? Because I know that we realized very quickly in Nevada, it's not as remote as Saskatchewan, but costs are incredibly high, right? And we're raising money in Canadian dollars, we're spending them in US dollars. That has not been a favorable situation in a bear market for the last 4 or 5 years. So we switched over to this hybrid exploration model in 2021. Didn't really announce it to the public, but just started doing deals, and then said, hey, by the way, we're this is a big part of our business model now. But we're very selective in who we pick for partners. We don't do deals with juniors. Chris, obviously, you're the same, right? You're picking the big guys in your space. So for our gold projects, we focused on bringing in Nevada Gold Mines. They are the best exploration group in Nevada for deep Carlin type gold deposits. And that's, obviously you want to put your best foot forward. So that's who we have as our partners in the gold space. Our porphyry CRD projects, we have partnered with South 32. And again, South 32 owns the Taylor deposit, which is one of the largest CRDs on the planet. They're putting that in development in Arizona. And so we actually actively sought them out and pitched them, hey, we want you guys as partners. And what I think it does is, for us, there's a lot of mutual respect between the parties, right? Like, we're the ones, we found these projects, we did the early stage drilling, we actually explored every one of these assets as if we were going to move it forward 100%. And then at some point in the exploration process, we realized, okay, it's too deep, it's too risky, or the market, in this case, the last couple of years, market won't support, wildcat drill holes. And so that's when we decided to bring in the partners. But we built really strong geologic models and exploration stories around each project. So it allowed us to bring in top tier partners and then negotiate very aggressive deals on Ridgeline's behalf. So it's worked out really well.
And I'd say, that follows a model that we've talked about before, and that I don't think somebody wakes up one morning, starts a business and says, I'm going to go be a project generator. I mean, I was always of a mind that every exploration company was generating projects. So what the hell are you talking about? I think you evolve into it. And when you see the companies that do all of a sudden hang up a sign and say we're a project generator, they're not really following the purest model that was originally thought up out of the gate. I mean, it's everybody's been trying to find a business model when it comes to exploration, because the problem with exploration is we deal in smoke. And it's hard to wrap your arms around valuations and things like that. And so, how do you turn that into a business model? And it's difficult, because it's typically, as you look at these companies, they've got a project. They don't have a business, they have a project. And when they're done finding out whether there's something there or not, they don't have a company anymore. So I think these are things you have to evolve into. And as Chad was saying, the traditional model is you find projects of worth, you invest in them, you bring them up to a level that you can attract interest from a bigger player, and then you go get a bigger player to help you to make the next move. And I think that's what's happened there, and what's happened in our case as well.
I agree with everything you guys are saying. I think it's fantastic, but it's always interesting to kind of share the kind of thought process at the time and as you move forward and now. But you can't have, Chad, thought, do you know what? Well, let me put it another way. Your choices were, let's go find a small company who's got some spare cash, and let's see if we can do a deal with them, because we'll be able to debate and argue our case on an equal footing. We're both small companies. If you're walking into South 32 or like that as a small player with not a lot of money in the bank, with not a big kind of balance sheet behind you, where's the confidence come from to say, hey, let's do this, where you fund me through to production, please?
Well, my wife has always said I have had an undeserved amount of confidence, so that probably didn't hurt the negotiations to start it off. But really, what came down
that's
to
her quietly telling you you're punching it well above your weight. Chad. That's all this. That's what she just said to you.
But aside from my wonderful wife, I'm confident knowing that, like, for me in Nevada, I have one of the best technical exploration teams anywhere in the United States, right? I'm comfortable in saying that. I know it because our guys have found out, I've found deposits, Mike's found deposits, my VP. We're comfortable in that. But the problem is that doesn't necessarily translate to a deep treasury, right? And so, I mean, walking into these big groups, I think that I always try to negotiate very candidly with groups, right? And say, look, I am perfectly capable of moving this forward. I can dilute this company to 300 million shares and go do this ourselves. But that's not what I want to do as a company. I'm the largest individual shareholder, and it's of no interest to me to be 350 million shares out and finally hit that big hole that finally changes it, right? I've always believed that, in exploration, I always tell shareholders, look, you're getting diluted either way. You're either getting diluted at the project level or the corporate level, but that dilution is coming. So what we're choosing is what we think is the least destructive level of dilution that provides the highest level of upside to ourselves and our shareholders. And so, to say, I've had I did these deals and I had shareholders that were livid that we did deals on these projects, right? oh, you've diluted us out, there's nothing left. And it's like, buddy, there's going to be nothing left either way if we don't make a discovery. But if we do make a discovery, let's say we find the next gold rush deposit at our Swift project. I mean, we're talking about owning 25% fully carried on a multi-billion-dollar asset. That is, a 10 to 20x on our current market cap. And if they, if a shareholder isn't happy with that return, they're in the wrong business, right? So that's always been, our approach to dealing with these majors as well. It's like, look, we understand what we are and aren't good at, right? We need your help. We need your money, right? But we know that we have a good technical background in this. And so let's do something that works for both groups. And all of these deals took 8 to 10 months to negotiate because they are unique. They're, it's not a classic walk in, give me a 2% royalty on the back end and, I'll get diluted to nothing. That's it. It wasn't easy to get them across the finish line, but I'm happy with where we've ended up.
Yeah, I think, we came at it a little bit differently in that we picked up our projects with Cameco and Orano early on. We actually earned in on those projects at the time, which was in the early 2000s. The two projects we're talking about, Hook Lake and Smart Lake, were on the western side of the basin, away from the fray. As a matter of fact, at the time, Orano didn't like the project at all, didn't want to put any more money into it. They were partners already. Cameco did, but couldn't really get a budget for it. And so they were looking, they actually started to tender this thing out. And when I saw that, I mean, it was a pretty heady time back there, 2005, 2006, in uranium. From our perspective, we had to have them as partners. Like, we thought that differentiates us somehow, some way, if we can earn in on them and have them as partners. And we pulled out all the stops to get in the door and present to these guys that we were the ones that they were going to let start throwing money at this thing. So we were prepared to throw money at these projects. I mean, we did take a look at it. I mean, we did understand that we thought they were valuable. Now, in the case of those, within a few years of us actually getting into relationship, all of a sudden NextGen found something right next door and Fission found something right next door. And these projects became valuable as a result of that and as a result of what we were pulling out of the ground. So that's how we wound. I didn't just go knocking on the door one day and say, will you be my partner? I got something to sell you.
A far better approach than what I did, Chris. I think you took the right way there. Yeah.
Well, but in the case of ISO, this, again, it's a relationship with people that we know from the industry. We knew them. It took a lot of time of just looking for a creative way to put things together. So in this case, it was both sides looking for a creative way to partner to make this stuff happen. And so it's over this time as these projects all of a sudden start getting put together. The Foran deal, again, that was something we went out and staked when times were low. We invested in it, as Chad would have, to bring it up to some level of understanding and value. And we knew that we were situated right beside a mine that was being put into production. So, that worked out well for us as that. So it's kind of been pieced together over time. But I think the real message, and probably Chad ran into this more than I, is you can't take a bad deal. Because we see too many resource companies walk into a major and take on a bad deal. And because they're so desperate for the news and for the excitement of, look what I've got, look what I brought home on, and they wind up with a bad deal. They wind up with a project that gets parked for the next 5. Their best project gets parked for the next 10 years, or they get squeezed out, or they get who knows what. But so the other message here is if you're going to do this, you have to stick to your guns, and if you've got a reasonable argument, for terms within those agreements, they'll, if the value's there, you'll get them.
Yeah, and I think that's a good point. I've commented on this space for far too long, and when we saw a lot of juniors making deals with Rio or BXP or whomever, and saying, right, we've made our fortune. Our fortunes are made. Life is going to be easy from now on. But of course, as you say, Chris, the big companies can and do tend to have multiple optionality projects like this, and will park some up for years. And these small companies can't wait, can't afford to do that. So
we had that situation with Rio Tinto, as a matter of fact, where they were earning in on one of our best projects and mucking the hell up out of it. But we had taken a long time to establish the rules of engagement and the terms of our relationship, and once they were done screwing around, we were in a position where we actually got the whole project back free and clear because we had to go into it with that. If we couldn't do that, then we wouldn't have done the deal. because we were just flushing a project.
No, and I think that's a really good point. Like you can't do a bad deal, but I think there's also a lot of junior companies, especially being run by geologists who maybe are great at rocks but don't really get the business side of it. And they're also on the other end of it. You have companies asking for just completely unrealistic deals, right? Being paid for upfront for success that hasn't happened yet and stuff like that. So I think that sweet spot when you're trying to do these kind of deals, and I think you hit it on the head there, Chris. They have to be reasonable, right? They have to make sense for both parties, and everybody needs to win if you actually do find something big, right? But like the idea of being paid up front for something that's just because it's beside a mine, right? With no actual discovery. We're in that same situation. We're on trend of some 20 million ounce gold mines, within a couple of kilometers. But our push is look, we're not asking for millions of dollars in upfront payments. We want that going in the ground. But if a discovery is made, all of our shareholders are going to have an absolute, smoke and win. So I agree. Like it's finding that middle ground. You can't have a shit deal, but you also can't have a deal that's so expensive and so outrageous that it forces the major company to either leave early because the threshold is so high for success that they can't be forced into a, let's say a balloon payment or a milestone. So it's finding that sweet spot where there's enough, you can still have a boot on their neck where they have to spend money, they have to do the work, but at the same time, you're not putting unrealistic thresholds there that force them to leave, because, you need to, I think the deals need to be structured in phases which allow for meaningful exploration and reasonable next steps into a deal, right? That without that, I think you end up having projects get stalled or shelved.
Right, and obviously, let's assume you get all these cuffs and collars in place and you protected yourself for the future. You're both intelligent men, of course you have. The other thing that people look to is this 10% management fee. It covers a lot, if not all, of G&A. So that's a smart thing out of the gate. And how do you go about? I mean, Chris, for you, and how do you go about defining what that number looks like?
Fortunately, it's kind of been baked into the industry because it's not a bad number. And I mean, when I say it covers overhead, it doesn't cover all of our overheads because it's meant to cover whatever overheads aren't going into the ground that you're expending as the operator to administrate all of that. And the 10% is a pretty good number. I mean, it comes back to us in a couple of ways. When we file assessment reports with the province of Saskatchewan, we can only file money that we have put in the ground. At the bottom of that, they give us a 10%, administration fee to tack onto it is what they do. And as we look around, we were able to see that it was a number that was used by all the majors amongst themselves, let alone with the likes of us. And it does change. So there's a different fee if you're exploring than if you're developing, than if you're doing reports, than if you're actually an operator in a producing scenario. So those numbers in and of themselves didn't take a whole lot of negotiating. They were just understood and time proven.
Yeah, you say 10%. You say 10% to any major, and they're like, "Yeah, that's fine, standard, right?" But if you say 15, suddenly they all go like this.
Well, yeah, then where are you coming from with that?
Because obviously, the natural inclination for you guys would be like, "Well, hey, if I can tip this a little bit more, it might kind of cover some of our own exploration interests outside of the JV." But they're wise to that, obviously. But it still helps.
Yeah, no, I mean the thing is too is like that 10% isn't quite right because like ours is 10%, but I also charge back all my geologist time. I charge back my office space on a pro rata basis based on kilometers of each. So like my square kilometer of each of my projects gets allocated. My office space and core storage yard is broken down based on that. So I can go back to South 32 and say, well, here's what your pro rata is to cover my cost for my office and my geos and etc. So in reality, I might be more like 14 or 15% if you actually did the full math on it on how it breaks down. So like if let's say a company's like, you know what, I want you to provide the office, the people, the trucks, everything, right? Then I'd say, okay, great, 20% of every dollar spent goes in our pocket then, right? But if they're like, no, you can charge back reasonable exploration expenses and overhead cost for the project, plus you get 10% of every dollar spent, to me, that's a better deal.
And that is a better deal, and it's more defendable and it's more negotiable than saying instead of 10, I want 15. You're better negotiating. Well, wait a minute, what can I charge the joint venture for like to your point, like we charge our geology time. We book it by the hour, by the day, but the joint venture gets charged for that time at cost, and because we get 10% on top of that. But yeah, I think it's you're better off approaching it and trying to get that little extra by in terms of what you're allowed to charge the joint venture as part of the exploration costs.
Well, let's look at this bit. The next bit's really, really important. So people listening, watching, reading about that, this is the important bit we're getting into now, which is how do you value companies like this, right? We talked about how you kind of have got to a point where you've negotiated some agreements, JVs. You talked about a management fee, which kind of covers a whole bunch of costs. The next bit is how much your partners choose to allocate to the projects, the joint venture projects, and how quickly they do that, and ultimately what you get from that. That's track one. And track two is, I think Chad, you talked about only 3 of your 7 projects are under that kind of JV agreement. Chris, you've got a bit more on top of that to do your own exploration. So can you just sort of talk, maybe Chad, talk to where people listening and watching this should be looking to and allocating value to? Because I think you're both, quite undervalued for what you are, because it's an understanding of what the model is. Exactly.
God bless you.
Exactly. She's right. It's like, if people can understand the business model, which I think we've done a good job of sort of explaining, and then understand where the torque, where the leverage is, that might help. So Chad, why don't you go for that?
Yeah, I mean, look, when I first started evolving into this side of this business model, I was incorrectly valuing what these deals were worth, right? I think at the end of the day, at the early days, the value is that you're using other people's money, right? The project itself may have little to no value, right? But at least you're not spending your own shareholder dollars to figure out if it's worth something. As those projects evolve, like in the case of this year, we're seeing $9.5 million US spent on our projects by our partners, 100% non-dilutive. And our market cap is around 25 million US. So, that's a really great ratio of dollars spent versus, what our actual market cap sits. And I think that the interesting thing that I always tell shareholders is like, you could take any one of, Swift or Selena, any one of our deals, you plop them into a single explorer, and that's the same market cap as what we are now, right? Like you could justify 35 million for either one of those projects as just a standalone story. So yes, the problem with being a prospect generator or a hybrid model is you tend to get discounted until that big discovery happens, right? A lot of people are willing to pay for exploration potential on a single asset project because it's very easy to say, if this hits, here's what it could be worth. We own 100%, and there's all kinds of comparisons in the market, right? So people can go, oh great, that could be a 10-bagger if they have one good hole. And that's no different than what Chris and I are doing. The problem is when it's all baked into all these different deals, your people are not paying for that exploration success up front. They're waiting till you make that big drill hole. Then I think actually the torque can be considerably higher because there's no question, if we hit at Swift, for example, no one's going to say, how are you going to fund it? Well, it's already taken care of, right? How is Barrick stock going to move on a major discovery? Not a bit, right? But the only way to participate in a new discovery, let's say at our Swift project, is through Ridgeline, because you are not going to buy Barrick stock and see it go up, 50, 60% on the backs of a, 100 or 200 gram meter hole. But you can see that happen with us. We could go 200 or 300% up on that same drill hole, right? So it's very torquey for us. There's zero dilution if that discovery is made, but it is difficult. I think it is difficult to value. And at times I even sit there and go, well, what, is the sum worth more than the parts, right? What if you say, if I'm saying that right? But so it is tricky. I think that's why you see typically project generators like us in bear markets are heavily undervalued. No one cares about them when times are bad. Thing that I like a lot is in this bear market, a lot of juniors, they hunkered down, they did nothing, right? They just kept G&A up and going. They shuttered all their operations, and now the market's great and they're like, hey, we're going to go make a big discovery. Well, we've been doing that for 4 years, right? We've been doing these deals. We have ongoing discoveries at 2 of the 3 projects, and we're seeing significant spending being done heading into a market that's already getting excited. So for us, I feel like we planted the seeds, if you want to call it that, of the story in a bear market. Got very little value for those deals, but I do think that's going to change very quickly. And then suddenly the people go, oh, wow, well, this is an overnight success. And it's like, yeah, it took 5 years. But, so anyways, I don't know if I answered that well, but Chris, did I miss something there?
Well, no, yeah. I mean, you're trying to put value on an exploration play, and that's always difficult. I think in our case, we've got a finite group of companies that deal in our space, and they go up and down as people get excited or not excited about uranium. So I think, I think the market's going to decide what we're all collectively worth, and you do see, if you look at them all, we all sit around the same market cap or what have you. So if you're trying to differentiate yourself prior to a discovery, if you will, that's the challenge. And it's so hard to wrap value around this, because if I'm a junior company, I've got a flagship property somewhere in the middle of the Athabasca Basin. You're rolling the dice. This is either win or lose. I won't know till it's over, or till you run out of money. In our case, we're trying to demonstrate the fact that our odds are better than the average bear. We know that over the last 20 years, there's been 6 big discoveries made, and every single one of them had to spend tens of millions of dollars before they hit their one discovery hole. So how do you get there? How do you think you're going to get there? Because we're not throwing darts at a board here. So by demonstrating that we've got multiple properties, which we've got multiple bets here that are validated by senior partners who can't free up budget unless they think there's something potentially there, and who are carrying the weight of the cost of this thing at these early risky stages, and we're able to do so in a fashion that kind of keeps the engine running. So we've got longevity, and we've improved the odds, and that's the only way we can really differentiate ourselves amongst a valued group of companies prior to discovery. I mean, but we've all watched the Lassonde curves, and we can pitch that as long as we want. You make it, and then that's where you get your biggest torque. But you just have to prove that you're the most likely to hit that hill.
That was a great point to make, actually. Like Rick Rule said it best about he's been a big investor in the company, and he actually said one of the things he liked the most about Ridgeline, not on top of the other people spending other people's money, is that he doesn't have to do the due diligence on the company, right? He's already got the biggest gold companies and base metal companies in the world who said this project has merit, and I believe in it. So from a shareholder perspective, if you're looking, you're right. Like, not only are we increasing our odds of discovery by spreading out that risk, but for the average shareholder who's looking at assessing a new company, there's so many bullshit artists out there, pardon my French, that just, I've seen projects in Nevada that we've, I live here. I've known about that project for 15 years. I wouldn't touch it with a 10-foot pole, but a bull market comes along and wow, I got this great new asset, right? And shareholders pile into it, right? And they're just assuming that CEO or that company is on the up and up. So I think that to have that validation from a major partner, it does go a long way.
Sure. It means that we don't have to walk around with a geologist trick clip to our belts.
Yeah.
To talk to investors, which is the last thing you want them doing.
Yeah.
And that's fair point. I think that validation component is such a big one, because that says to me that your companies are built on strong fundamentals, not the desire and need for a momentum play when the market is right. I think that's good. The other thing, Chad, I think I was going to re-emphasize, because you made a good point earlier in terms of the not just these kind of capital structure arguments, but also the share register and share structure as well. If you're blowing the share structure out of the water, you're ruining your chances of any kind of growth appreciation on the share price going forward. So those are the things that investors should look to. This is a get rich slow scheme, but it's get rich nevertheless, because it's heavily de-risked. So guys, what I'm going to let you just maybe give us 30 seconds worth on each of your companies, and what have investors not involved in your companies currently got to look forward to maybe help them get over the line. Chad, why don't you go for it?
Sure. I mentioned previously that we have a $9.5 million budget going on this year. The lion's share of that spending is just across the 2 projects, Swift and Selena. At our Swift project, we drilled 10 grams per ton gold over a meter within a 3-meter interval of 7 grams last year, and they're following up on that now. And just to put in perspective, the 4-mile deposit, which is directly on trend of our project, on the same Cortez trend, that's just been touted as officially like the highest margin gold deposit on the planet. So we're hunting in the right district. We got the right partners, and we've already proven that there is potentially economic gold on the project, and they're putting $5 million in the ground this year. So this is an incredibly impactful year for us. At our Salina project, again, we've put 10,000 meters into that. That is a bona fide CRD discovery our team made over the last 3 years. And so the question isn't, is it there? It's just how big is it, right? And so that's what South 32 is helping us solve right now. We have drilling going there as well. So through the end of the year, this will be the biggest 3 months of the company's history as we hopefully advance these discoveries into something that really turns some heads. So yeah, I think it's an exciting time to be a Ridgeline shareholder.
Yeah, we've had a busy year as well. I guess through these partnerships, we've put about $8 million in the ground so far this year, and on our Dorado project with ISO, we've made a big discovery right out of the gate on our first program with them. We're hitting uranium up to 8%, and that's what we're going to be following up come wintertime. This project is adjacent to and on trend with ISO's Hurricane deposit, which is the highest grade deposit on the planet, 45% uranium, a little nutty. Which was the attraction of that area to putting a lot of this stuff together, so we could go looking for the next one. So we're just heading into our planning seasons with all of our partners and our budgeting, and we're looking to be spending a lot more last year than we did even this year. So it's going to be busy, and we're heading into what we all see as a uranium bull market over the next year anyway. So all things are working in our favor today. We'll see what tomorrow brings, but for now, things are good.
Right, gentlemen, look, I'm gonna wrap it up there. Look, two great companies. If you're listening to this, watching this, two companies definitely worth looking at. Love the business model. Stay in touch, gentlemen. We'll see you soon.
Thank you.